Hello friends, welcome to the world of business study by my YouTube channel Clear Concept. Now, in this discussion, we'll be starting with our BST Part 2 with the topics which we are going to cover today is factors affecting financial decision, factors affecting dividend decision and financial planning meaning. Now, let's move to our first slide where we are going to learn about factors affecting financial decision. These are the following points of factor affecting financial decision. The first one is cost. Now let me explain you all these points one by one in detail. The cost of all the sources of finance is different. The rate of interest on debt, fixed rate of dividend to be paid on preference share capital and the expectations of the shareholders on the equity share capital are in the form of costs. If these situations happen to be favorable, the benefit of cheap finance can be availed by choosing debt capital. Now the next one, that is risk. Debt capital is most risky and from the point of view of risk it should not be used. The next one, that is flotation cost. From the point of view of flotation costs, retained profit is the most appropriate source. Therefore, its use must be made. Next, that is cash flow position of the business. If the cash flow position of the business is good, the payment of interest on the debt and the refund on capital can easily be made. Therefore, in order to take advantage of cheap finance, debt can be given priority. Next, that is level of fixed operating cost. In business, there are mainly two types of cost: fixed operating cost and fixed operating cost and fixed financial cost. Fixed operating cost is rent of the building, payment of salary, insurance premium, etc. Whereas fixed financial cost is example interest on debt, etc. If the level of fixed operating cost is in excess, it is better to keep the fixed financial cost at their minimum. Therefore, debt capital should not be used. On the contrary, if the level of fixed operating cost is low, the use of debt capital is profitable. Now the next point, that is control consideration. The ultimate control of the company is that of the equity shareholders. Greater the number of equity shareholders, the greater will be the control in the hands of more people. There is not a good situation. Therefore, from the point of view of the equity share capital should be avoided. Now the next point and the last point is state of capital market. If the stock market is rising, then it is easy to sell equity share. But in a depressed capital market, the company has to opt for the debt financing. These were all about the factors affecting financial decision. Now the next one, that is factor affecting dividend decision. The first point is earning. Now, the dividend is to be paid out of the present and the reserved profits. Therefore, greater amount of total profit will ensure greater dividend. The next point, that is stability of earning. A company having stable earning in a position to declare more dividends and vice versa. The next point, that is stability of dividend. Every company has the policy of maintaining the stability of dividend per share. Here, the stability of dividend means that the dividend will not or in no case will be allowed to fall. It is always a good if the dividend remains stable or increases. From the point of view, a little change in profit should not be allowed any increase or decrease in the dividend. The next point, that is growth opportunities. If the company has more opportunities for growth, it will require more finance. In such a situation, a major part of the income should be retained and the small part of it should be paid as a dividend. The next point, that is cash flow position. The payment of dividend results in outflow of cash. It is possible that the company may have enough income, but it is equally possible that it may not have sufficient cash to pay dividend. In this way, the cash flow position of the company is a factor that determines the dividend decision. The better the cash flow position of the company, the better will be the capacity of the company to pay dividend. The next one, that is shareholder preference. There are two types of shareholder from the point of view of investment. First one, that is those who have interest with the purpose of getting more regular income, and the next one, that is those who invest in the company to gain capital profit. If the majority of the shareholders are of the same former type, the company must declare dividend according to their expectation. On the contrary, if the majority of the shareholders are of the latter type, of the company enjoys freedom about declaring dividend. The next point, that is taxation policy. If the tax on the dividend is higher, it is better to pay less by the way of dividend. But if the tax rate are lower, higher dividend may be declared. This is because, as per the current taxation policy, a dividend distribution tax is levied on companies. However, shareholders prefer higher dividend, as dividends are the tax-free in the hands of the shareholders. Next, that is stock market reaction. Generally, an increase in dividend has a positive impact on the stock market, whereas a decrease or no increase may have a negative impact on stock market. Thus, while deciding on dividend, this should be kept in mind. Next, that is access to the capital market. Large and reputed companies generally have easy access to the capital market and therefore may depend less on retained earnings to finance their growth. These companies tend to pay higher dividend than the smaller companies. Next, that is legal constraints. Certain provisions of the Companies Act place restrictions on the payouts as dividend. Such provisions must be adhered to while declaring the dividend. Next, that is contractual constraints. While granting loans to a company, sometimes the lender may impose certain restrictions on the payment of dividend in future. These companies are required to ensure that the dividend payout does not violate the term of the loan agreement in the regard. These were all about the factors affecting dividend decision. Now the next point which we are going to see today is about financial planning. What is financial planning? Financial planning is the process of estimating the capital required and determining its competition. It is the process of framing financial policies in relation to procurement, investment, and administration of funds of an enterprise. Now, I'll be explaining you this more in detail. Financial planning is an important function of financial manager and also a part of the overall planning of any business. Financial planning ensures that enough funds are available at right time. Both inadequate and excess funds are terminal for an organization. If the funds are not adequate, an organization will not be able to meet its commitments. On the other hand, if the funds are in excess, it will add to the cost and may encourage wasteful expenditure. Thus, financial planning is the process of determining the objectives, policies, procedures, and programs to deal with the financial activities of an organization. Financial planning aims to match the requirement of funds and their availability at the right time. It takes into consideration the growth, performance, investments, and requirements of funds for a given period. Financial planning is deciding in advance the course or the line of action for the future in respect to the financial management of a concern or financial planning is essentially the preparation of financial blueprint of an organization's future operations. The objective of financial planning is to ensure that the enough funds are available at the right time. Financial planning pertains only to the function of finance and includes the determination of firms' financial objectives, financial policies, and financial procedures. Now, in financial planning, we can even say that, or there is another definition of financial planning, we can even say that to predetermine what is to be done in future is called planning. Financial manager has to formulate plan regarding future financial requirements, procurement and utilization. Financial planning therefore refers to the predetermining of financial activities so that the objectives of the organization could be achieved. In short, it includes financial objectives, financial policies, and financial procedures. In the next discussion, we'll continue our discussion on the topics like objectives of financial planning, importance of financial planning, and capital structure. Let us know your doubt or any specific query below in the comment section. Subscribe us and ring the bell button so that you won't miss any important update. Till then, enjoy studying business studies.